A sound tax system aims to distribute the tax burden fairly among individuals and businesses based on their ability to pay. This principle suggests that those who have higher income or greater wealth should contribute a larger portion of their resources compared to those with lower income or less wealth. Equity can be achieved through progressive taxation, where tax rates increase as income or wealth increases, or through other mechanisms that promote fairness. Fiscal adequacy refers to the principle that a tax system should generate sufficient revenue to fund government expenditures and public services. Taxes need to be set at a level that meets the funding needs of the government while balancing the impact on taxpayers and the overall economy. Fiscal adequacy also involves periodically assessing tax rates and structures to ensure that they align with changing economic conditions and fiscal requirements. Lastly, administrative feasibility in a tax system means that it should be easy to understand and comply with for both taxpayers and tax administrators. Simplicity reduces compliance costs and minimizes opportunities for tax evasion. Complex tax system can create confusion, lead to errors, and require excessive resource for administration. A simple tax system promotes transparency and enhances public trust. The situs of taxation refers to the jurisdiction or location where a particular tax is imposed or levied. It determines the legal authority and geographic scope of a tax. The situs of taxation can vary depending on the type of tax and the specific laws of a country or region. Here are some examples. The situs of taxation for income tax is usually based on the source of income. Most countries impose income tax on their residents' worldwide income, regardless where it is earned. On the other hand, non-resident citizens may also be subject to income tax on income derived from within a particular jurisdiction, such as income from employment, business activities, or investments conducted within the jurisdiction. Our next example is the situs of taxation for sales tax or VAT is typically based on the location of the transaction or the place of consumption. In many countries, VAT is imposed at the point of sale, meaning the tax is levied when a product or service is purchased by a consumer within the jurisdiction. Next example is the situs of taxation for property tax is generally determined by the location of the property. The tax is imposed by the local government where the property is situated. And the last example is the situs of taxation for estate and inheritance tax is typically based on the jurisdiction where the deceased person was domiciled or the location of the assets being transferred. Different countries have varying rules regarding the taxation of estates and inheritance, including exemptions, threshold, and rates. Tax evasion refers to the illegal act of intentionally and deliberately evading or escaping the payment of taxes by engaging in fraudulent activities or concealing income, assets, or transactions from tax authorities. It involves willful noncompliance with the tax laws and regulation in order to reduce tax obligation or avoid paying taxes altogether. Examples of tax evasion include underreporting income, inflating expenses, using false documents, keeping unrecorded transactions, or hiding assets in offshore accounts. Tax evasion is usually universally considered illegal and is subject to penalties, fine, and possible criminal prosecution. Tax avoidance, on the other hand, is the legitimate practice of organizing one's financial affairs within the boundaries of tax laws to minimize tax liabilities. It involves using legal strategies and taking advantage of available tax incentives, deductions, exemptions, or loopholes to reduce the amount of tax owed. Tax avoidance is based on the principle of taxpayers' right to arrange their affairs in a tax-efficient manner as long as they comply with the letter and spirit of the law. Examples of tax avoidance includes utilizing tax deductions, structuring business operation in a tax-efficient manner, or engaging in strategic financial planning. The key distinction between tax evasion and tax avoidance lies in their legality and compliance with tax laws. Tax evasion is illegal and involves deliberate deception or concealment of information from tax authorities, while tax avoidance is legal and focuses on utilizing available tax planning strategies within the framework of the law.